From the following information, calculate the following ratios, that is debt to equity ratio, proprietary ratio, and debt to total assets ratio. Now this is the balance sheet given to you, and from this balance sheet you have to calculate the above given ratios. In this question we need to find debt to equity ratio, and here we have the formula. Debt to equity ratio is long-term debt by shareholders fund. Now before this we need to find out these two factors, long-term debts and shareholders fund. Long-term debts will include your long-term will include long-term borrowings and long-term provisions. Now let's go back to the question and let's find out here. This long-term borrowings and long-term provision is under the heading non-current liabilities, and you have the amount 4,50,000 and 50,000. So 4,50,000 and 50,000 will give you altogether 5 lakhs. So you have long-term debt 5 lakhs. Then now shareholders fund. Shareholders fund means share capital, reserve and surplus. So let's have in the question here, you have share capital, reserve and surplus here. Share capital is 15 lakhs, whereas reserve and surplus is 6 lakhs. So you have the total is 21 lakhs. That is share capital plus reserve and surplus. 15 lakhs plus 6 lakhs will give you 21 lakhs. Now you need to calculate proprietary ratio, and the formula is shareholders fund by total assets. Shareholders fund we have already calculated previously, which is 21 lakhs. What you require is total assets. Total assets we can get from the balance sheet. Here the balance sheet value is 40 lakhs. So here you have proprietary ratio, shareholders fund by total assets, shareholders fund 21 lakhs, and the balance sheet total is 40,000. So when you divide, you get 0.53:1. Similarly now, debt to total asset ratio, you have the formula total debts by total assets. Total debts means here long-term debts. Again long-term debts previously calculated 5 lakhs, and total assets again we have already got it in the previous number, right? So it is 5 lakhs divided by 40 lakhs gives you 0.125:1. The following data has been abstracted from the annual accounts of a company. Share capital along with number of equity shares, general reserve, securities premium, 15% long-term loan, profit before tax, provision for taxation, proposed dividend, fixed assets, current assets, and from these details you have to calculate debt equity ratio, debt to total assets ratio, interest coverage ratio, return on investment, earnings per share, and price earning ratio, and the market price is given to you rupees 35. So we have debt equity ratio. Your debt equity ratio, the formula is long term debts by shareholders funds. So in the question now, you have 15% long term loan here, and the amount is 3 lakhs, and another component is shareholders fund. For shareholders fund you need to take general reserve, securities premium, and share capital. So here you have shareholders fund, share capital, general reserve, securities premium. You have share capital 2 lakhs, general reserve 1,50,000, and premium is 50,000. So here you have 2 lakhs, 1,50,000, and securities premium is 50,000. So the total is 4 lakhs. So the amount here 3 lakhs divided by 4 lakhs gives you 0.75. Next is debt to total asset ratio. Formula is long-term dates by total assets. Long-term dates same as the previous amount, 3 lakhs. Now let's understand about the total asset. Now total asset, if you let's go to the balance sheet. In the balance sheet, on the liabilities side, you have three components: shareholders fund, non-current liabilities, current liabilities. So the total of this is the total of the balance sheet. So assets, the liabilities equals to asset, and on the asset side you have non-current assets and current assets. The total of this will be the total of the balance sheet. Non-current asset means fixed assets. So in order to find out the total assets, you need to take non-current assets and current assets. So what are the non-current assets and current assets here? Fixed asset, which is 6 lakhs, and current asset, which is 4 lakhs. So 6 plus 4 is 10 lakhs. So here you have total assets, fixed assets and current assets. Fixed asset is 6 lakhs and current asset is 4 lakhs. So the total is 10 lakhs. 3 lakhs divided by 10 lakhs will give you 0.3. Interest coverage ratio. For this you need to find profit before interest and tax divided by the interest. Now interest, how do we calculate interest? Interest is paid on borrowings. So here you have only one borrowing, that is 15% long-term loan. 15% is the rate of interest. So the total interest will be 15% of 3 lakhs, that is 45,000. And yes, you need profit before interest and tax. Okay. So now we have profit before interest and tax. So we have here profit before tax is 1,40,000. So here we have 1,40,000. And then interest on loan is 15% of 3 lakhs. So 15% of 3 lakhs is 45,000. So you have 1,85,000. So here you have profit before interest and tax, 1,85,000 divided by 45,000 gives you 4.1 times. Now return on investment. Profit before interest and tax divided by capital employed. Now what is the meaning of capital employed here? Capital employed means the total investment made. And how do you find the total investment? Total investment, again let's go back to the balance sheet. Total investment, when you would like to find out the total investment, you have to add up shareholders fund and non-current liabilities. And what is the total amount put into the business? Own fund and borrowed fund. These will give you the total investment or total capital employed. So here shareholders fund we have already calculated, and non-current liabilities is 15% long-term loans. So your capital employed is, and your shareholders fund as calculated above is 4 lakhs and long-term loan is 3 lakhs. So the total value is 7 lakhs. So you have here profit before interest and tax, same amount, 1,85,000 divided by 7 lakhs. And this is always expressed in terms of percentage, so multiplied by 100, so you get 26.43%. So let's understand this part. Net profit. From the net profit, a company pays interest on borrowings, tax to the government, dividend to the preference shareholders, and the remaining profit goes to the equity shareholders. Net profit after deducting the interest on borrowing is termed as profit after interest or profit before tax, PBT. So PBT means this is the profit before the tax. Now the tax will be paid to the government from this profit. So the profit after deducting the tax will be termed as profit after tax. So this is a profit, PAT, after deducting the tax. Now from this profit, dividend to the preference shares will be paid. So you deduct the dividend component, you get profit after tax and dividend. Profit after tax and dividend. Then this profit, which is profit after tax and dividend, is the profit available for the equity shareholders. Now out of this profit, this available profit, certain amount will be taken to reserve and surplus will be retained or will be kept in the business as reserve, and some amount will be distributed to the equity shareholders as dividend. Now the question comes, if you need to find out net profit before tax, then what you need to do? Supposing this profit is given to you, profit after tax and dividend is given to you, and you have to arrive at profit before tax. Then you have to work out backward. So profit after tax and dividend, you add the tax, you add the dividend, then you get profit before tax, because profit before tax is here. That means in order to get profit before tax, you have to include the components tax, dividend, and if it is there, this also has to be added. Earnings per share formula is profit available to shareholders divided by number of equity shares. Now let's understand how to calculate profit available to shareholders. Now in the question, what is given to you here is profit before tax, PBT, profit before tax and provision for tax. These two components are there. There is not this proposed dividend is the dividend for the equity shares. This is just proposed, it is not paid. Okay, so here you have this component is not there, but profit before tax is given to you in the question. You have to arrive here. So how do you arrive here? This minus this, you come here. So profit before tax minus provision for taxation, this dividend is not given, right? So you arrive at profit available to shareholders. Profit available to shareholders is profit before tax 1,40,000 minus provision 84,000, provision for taxation. So you have 56,000. So it is 56,000 divided by number of equity shares, and number of equity shares here as mentioned in the question here 20,000 equity shares. So 20,000 gives you 2.80. Price earning ratio formula is market price per share divided by earning per share. Market price is already mentioned here, 35 rupees. So 35 divided by earning per share, which is calculated here. So you have 12.5.